Hello, everyone, and welcome. Thank you for joining us today. My name is Priya Patel, and I'm part of the client solutions team at iCapital covering the Middle East. Prior to joining iCapital, I worked at a global hedge fund, so it's a pleasure to moderate today's discussion with two industry leaders. We're hosting today's webinar in response to growing client demand. Over the past several months, we've seen a noticeable increase in conversations around hedge funds and the role that they can play within client portfolios. Today's discussion is intended to provide a practical perspective on the asset class from the current market backdrop and portfolio construction to manager selection, implementation, and the evolution of the industry. Before we begin, I'd like to thank everyone who submitted questions ahead of today's webinar. Please feel free to continue submitting questions through the Q&A button at the bottom of your screen under More. Your questions will only be visible to the panel, and I'll do my best to incorporate as many of them as possible throughout today's discussion. It's now my pleasure to introduce our speakers. Gil Caffray is a chairman of MPW Capital Advisors. Gil has spent more than 3 decades in the hedge fund industry, including senior leadership roles at Tiger Management and co-founded Front Point Partners, one of the industry's leading multi-strategy hedge fund firms. He brings a unique perspective as both an investor and hedge fund founder. Joining Gil is Joe Burns, managing director and head of hedge fund research at iCapital. Before joining iCapital, Joe spent many years evaluating and allocating to hedge fund managers, including at Soros Fund Management, giving him deep experience across manager selection, due diligence, and portfolio construction. Gil, Joe, thank you so much for joining us today. Gil, if we can start with you. Over the past several months, we've seen hedge funds become a much bigger part of the conversation with investors and advisors alike. From your perspective, what's driving that renewed interest, and why do you think hedge funds are particularly relevant in today's market environment?
Investors always recognize that the talent in hedge funds is rather acute and has a specific way of being able to attract and commercialize opportunities. I think the whole lexicon around portfolio construction has been turned on its edge for the last few years, as private markets have not done as well as public markets, and public markets have attracted more and more liquidity and attention. So it's not surprising to see money flow towards hedge funds. What I've seen is that the old model of an endowment model, where private marketplace is very much part of the central core, has given way to even more liquidity in terms of public. What you found is the dispersion and non-homogeneity of the markets have created enormous opportunities for all types of hedge fund strategies. Long short works very well in a high interest rate environment where you're getting a short rebate, which gives you basically a starting credit at the beginning of the month. More importantly, great fundamental research gives you the ability to be able to capture alpha, both on the long side and the short side. So as a result, you're able to really bifurcate the ability to take the marketplace, and not just as a whole, but really using your skill set and domain knowledge. One of the things that I think is very exciting right now is that there's so much disconnect in what's going on in geopolitics. It's hard not to just recognize that macro conditions now are probably perfect for the ability to, whether it's looking at what's happening in Japan and looking at the degradation of their currency and what's happening with the capital flows there, looking what's going on in basically the term structure of interest rates. I think if there's one thing we're going to be focusing on going forward is the enormity of the debt in this country, and what that's going to do if at some point the long end of the U.S. curve starts to be not anchored by the numbers we see on the screen, and what that does to the whole landscape of investing. That's very important. The other thing that I think is just so exciting is that investors around the world have decided they want to spend time here. And so there's been a tremendous amount of interest out of the Gulf to basically back teams to use this as part of their portfolio construction. And I know Joe will be talking about that, but it's an important change in what's been going on in the marketplace.
Well, I would, at this point, love to bring Joe into the conversation. I mean, Joe, given your experience evaluating hedge fund managers over many, many years, how should investors really think about the role hedge funds can play within a broader portfolio, as more of what objectives should they really be looking to achieve through an allocation?
Sure, Brian, thank you, and great to be with you. Always great to be with you, Gil, and thank you everyone for joining us here today. I think maybe probably just taking that half a step back for just a quick moment. If you think of building out a well-constructed portfolio, hedge funds being a part of that, public markets, private markets, the 3 main ingredients are always capital appreciation, wealth preservation, and portfolio diversification. So I think if that's a starting lens in terms of thinking about asset allocation, from there you determine, well, where do hedge funds fit? And what's changed, and Gil hit on some of this already, almost 180 degrees over the last several years, from maybe the decade plus coming out of the GFC, you were able to get each of those three ingredients, really just investing in public markets and maybe amplifying that with private markets exposure. And what we mean by that is you can get capital appreciation through equities. Rates are at zeros. Risk assets are almost mathematically on sale. You were able to preserve capital through fixed income, which really had no duration or credit risk during that period. And you had the portfolio diversification because they were stocks and bonds almost perfectly negatively correlated for 10 or 12 years. So you fast forward to the last few years, thinking about where hedge funds can fit in a portfolio, they almost went, maybe this is an exaggeration to prove the point, they've almost gone from an 0 for 3. Now, great managers always have very solid, strong additive fit in a portfolio, but now almost 3 for 3. You can think about certain strategies that can drive capital appreciation. Gil mentioned long short equity. Some of us grew up in double alpha. You can make money long and short when there's delineation and differentiation of stocks. So you can get equity-like returns with less risk and less outright directionality. So that can be an appreciation of your capital dimension. Wealth preservation, clearly fixed income has not done a phenomenal job protecting capital. We can only go back to, say, 2022. Duration risk, more recently credit risk, perhaps imminently upon us. Their diversified multi-strategy hedge funds have for decades proven the job of helping clients protect capital. And then that diversification piece with stocks and bonds now positively correlated, non to negatively correlated strategies like macro, some multi-asset class investment funds that we work with are able to provide that third dimension. So think about the totality of a client portfolio. We can appreciate capital through equity-oriented hedge funds. We can protect wealth through diversified multi-asset class investing, and you can diversify through non-correlated strategies. So it's a great backdrop to pick different hedge fund strategies to fit inside client portfolios today.
I did want to pivot the conversation into a question that we did receive earlier. And Gil, this is for you. As you're aware, and this question is regarding talent war. As you're aware, we've seen increasing attention on attracting and retaining top investment talent across the hedge fund industry. From your experience, what distinguishes the firms that consistently build successful investment organizations over the long term?
Well, there's no question that culture is the most important aspect, and that leads from integrity. If you don't have integrity of your product, you're not forthright with your investors, if you're not constantly a good citizen to the marketplace, if you're adversarial, you're going to find yourself basically seen as a pariah. One of the great things that I've seen as the industry has really evolved over the last 40 years is the understanding of the fact that I think there's a lot of misnomers about what hedge funds are. They're not gunslingers. They're not people that are taking outside risks where you as the investor are sort of taken along for the ride. I think they're incredibly well thought of risk managers. That's the most important thing. Joe's talking about, basically capital preservation as being the hallmark and bedrock of what we're talking about. But it's the idea of their being able to take specialized knowledge and take advantage of it. There's no question that what you understand, even when you look at the fact that there's going to be drawdowns in situations, but it's that resilience and understanding the character that allows people to build a culture where people don't think of this as something it's not anomalous to lose money at a given point in time, but the curiosity and the resilience necessary to reinvest in yourself. One of the great things about our industry is that we're forced every day to get better at what we're doing. And so you look at what's happening in terms of AI, you look at some of the best managers we had in terms of underlying fundamentals were people who literally were counting pallets in the back of Walmart 30 years ago, because that was the best way to get KPIs and what was going on in the business. Clearly now we're in the business of not only just web scraping and satellite photos, but we're deep into the thematic of being able to think of the second and third order effects that affect every part of our lives. But the culture has to start with a collegiality that gives people the ability to believe that they're investing in something, and with the long-term perspective that all sides are being advantaged by being together as partners.
I mean, listen, you brought up some very good points, right? And you touched on some really important topics in terms of culture, but also evolution and AI. And that just really helps me segue into the next question. Having previously worked at a large hedge fund myself, I saw firsthand how technology increasingly became embedded in the investment process. So Gil, maybe we can start with you, and then I would love to pivot to Joe. You've had a front row seat to the hedge fund industry for more than 3 decades. And as you look ahead, what do you see changing over the next 5 to 10 years? And in particular, how do you think artificial intelligence is really changing the way managers conduct research, generate ideas, and compete?
There's two things to that equation, Priya. I mean, one, what internally what you're doing in order to basically look for those key metrics. I think of as a good analyst looks at 100 different parameters. At any given time, only 3 have the fulcrum of actually being able to make a quantum change in the perspective. Portfolio manager takes all the best ideas and tries to put them in a covariant framework to make it the best. And the owner of a firm is trying to look at all the different risks that they want to have versus the risks they do have and trying to put it in the right perspective. I think AI does an amazing job of being able to delineate some of those risks and make them much more apparent. So your dashboard of understanding becomes that much better. Critical thinking is never going to change, but I think the assembling of the data is going to improve dramatically.
Very good point. I mean, I would love to hear on the other end of the spectrum, Joe, as your team evaluates managers across a broad range of strategies, are you seeing AI emerging as a meaningful differentiator today, or is it becoming more of a capability that every leading manager is expected to have?
Probably more the former. I think the adoption of AI, it's in every business, in every sector, it's happening as fast as sort of internet adoption for 25 or 30 years ago. So when we look at managers, the ability and focus to enhance processes utilizing artificial intelligence. Many of these managers, while it's new to some of us from an industry standpoint, some multi-strategy managers, quantitatively focused managers have been using these processes, large language models and, neural networks to really, to Gil's point, aggregate, synthesize, analyze data more effectively, more quickly. So we've seen this trend going on for years. This is not necessarily a new phenomena for many of the GPs we work with. So it's in terms of just making more informed decisions more quickly. It could be utilized from a risk management standpoint. So we've seen market leading hedge funds using and accelerating the use of AI in terms of their business processes for years. And I think it's both on the front end from a research and portfolio management and portfolio construction standpoint, and as importantly on the back end in terms of helping with risk mitigation, stop loss techniques, reallocating capital. So over time, as some of the sort of trouble spots that Gil referenced at the beginning part of the call, accelerate, I think having AI ability to move faster, move more thoughtfully in rebalancing or reconstructing a portfolio, that will only increase in its pace and adoption, and market leading firms are going to be at the forefront of that.
Very well said. I mean, and this is me pivoting into another topic. And one of the questions that we did receive ahead of today's webinar was for an investor looking to make their first hedge fund allocation. How should they really think about building that exposure? And Joe, perhaps you can walk us through the key considerations and how you really think about portfolio construction.
Yeah, I'd say the first question, it's one of two. One of, again, if we think about dimensionalizing a portfolio in terms of those primary ingredients of appreciating capital, protecting existing wealth, and maybe just thinking of non-correlated return sources from a diversification standpoint, that can help sort of point the arrows in a certain direction. If it's equity-oriented strategies, multi-strategy, macro investing by way of 3 examples. But I think pretty maybe more fundamental to the question is, I think it's about expectation setting at the outset. So oftentimes we work with advisors on a global scale, those that are just starting to or increasing the pace of adoption and utilizing hedge fund strategies. Diversified multi-asset class, multi-strategy funds tend to be the most typical starting point. Oftentimes, they run very large pools of capital relative to some competitors. They have very long track records. They have proven ability from a risk management standpoint. There's no guarantees in this business, but the consistency of their high Sharpe ratio, consistent low double-digit net return, mid-single-digit volatility with little or no equity beta or sensitivity or dependency on risk assets, that tends to be an area that if you think of it almost from a core satellite type approach, a diversified multi-strategy firm, we work with several, can be thought of as a core allocation. Then with satellite allocations to maybe higher octane strategies, could be focusing on equities, could be more dynamic asset allocation within macro. Those can be highly complementary. So again, every firm is different. Clients are at different phases of their life journey, financial journey. So it's hard to generalize, but I do think diversified multi-asset class serves as a really core ballast inside of a client's portfolio. We think of them often as stabilizers, and then you can sort of bookend that with equity, macro, other strategies to round out the picture.
I'll move on to the next question that came in. As hedge funds increasingly launch private market strategies, what do you think is a source of their competitive advantage?
From my standpoint, I think it's the whole orthodoxy of understanding, companies in general. So from that standpoint, we've seen a much greater tendency for companies to stay private far longer. So I think it's very important for managers that have been in the public sphere of hedge fund investing to be able to recognize that there's many ways that they can partake in those early startup companies and find themselves in a situation where they're part of that ecosystem in a very early part. So yes, we're seeing in some cases companies finally going public after 15, 20 years. And yet at the same time, the amount of money that's in the system, it makes an awful lot of sense for people to have hybrids. And so some of the most successful firms are ones that have the ability to go across the spectrum from literally from venture to, obviously large cap public equities. And so I think it shouldn't be seen as something that's anomalous. It should be seen as something where the same practitioners are utilizing in each of those ecosystems their best talent to basically make sourcing and at the same time delineating what they need for their portfolio and for the fabric of the relationship with their investors. So it should be seen as something very additive.
Yeah, and maybe one just add-on point. I think as the industry, the alternative asset management industry, hedge funds and private markets has evolved, it's become, I don't like to use the word institutionalized, but to a degree, people have been more thoughtful managers, let's focus within hedge funds, on building out durable businesses. And to Gil's point, just the sheer volume of companies that don't have publicly traded securities dwarfs that of what's available in public markets, trends that we've all seen really firsthand for now decades. So I think one advancement that the industry has sort of adopted, which is to the benefit of clients, is sort of thinking ex ante, what is the right structure? What's the right packaging? How can I make this product available to clients in different parts of the global economy? So it's not a one size fits all asset liability mismatching risk. It's really thinking about the client, how we can provide alpha generating returns in more or less liquid underlying securities, and utilizing those same research, investing, risk management processes that we've built out, often enhanced or amplified by artificial intelligence, to take advantage of opportunities in public markets from a hedging standpoint and as well in private markets. So again, for the broader industry, and I think to the benefit of clients, as mentioned, it's a really exciting time for certain managers, not all, to take advantage of a wider swath of opportunities spanning both public and private markets.
There are a few questions that are coming in, so I'll start shooting them off. How much should I allocate to hedge funds?
I think it really comes down to the architecture that Joe's pointing out. You really have to understand the key parameters you're trying to advance with your investing. And from that standpoint, I think that hedge funds can be a very strong complement, but there's no way to sort of, whitewash it as a generic sort of way of looking at it. I think it's very important to just look at the attributes that those types of funds, the bedrock of a multi-strat that can give you very good risk-adjusted returns without a lot of beta exposure, I think is something that's very important as sort of the underlying litmus as to what you need to look at. And then there's ways that you can add, as Joe mentioned, the octane of being able to have specific ways of looking at taking advantage of higher volatility strategies that are going to be complementary. The fact that you can do also things in the non-equity field that are basically non-beta oriented to the equity that's probably most pervasive in your portfolio is another way of giving you the type of risk parameters to feeling like you've got some attenuation to the overall exposure. So you're not sitting there with a sort of a beta of one, basically overclouding your whole ability to be successful. But I think that, Joe's right in that, you have to understand where you're going to make these inroads, but you should feel comfortable that you're not walking into a situation where you're investing with entities that are either immature or they're not understanding of exactly why you're there. I think it's a very important part of, disavowing about what the hedge fund industry is today versus what it was 30 years ago. I think it's become much more institutionalized, which is usually not a good word, but at the same time, I think it's become much more grown up in the way that both sides appreciate the resources that are necessary in order to make it successful.
Joe, you and your team.
Yeah, Brian, we've talked about it. I know the iCapital side. I think just from a hedge fund allocation standpoint, it's a fundamental challenge for advisors, right? And we talk about it with clients all the time. because it doesn't singularly fit in one of those buckets or one of those asset allocation pieces. Private equity, private credit, while maybe comparatively complicated in terms of a lack of, transparency or information, at the end of the day, they're equity and credit instruments in companies that just happen to not be publicly traded. So it's easier for advisors to understand where the fit is. Hedge funds, it's a bit of a more fundamental challenge. I think there'll come a day, and it's probably a long ways away from where we are today, but, just the use of alternatives maybe goes away. And maybe we're thinking about, what do I want my client invested in it and exposed to that will appreciate his or her capital? And that's typically equities. And that could be long only public, hedged public, private equity. How do I protect my existing client's wealth? That's often fixed income, credit, some hedging strategies fit in very nicely there. And then lastly, from a diversification standpoint, infrastructure, private markets, real assets, commodity, certain macro trading strategies. So I think hedge funds can fit in each. Again, Gil hit it perfectly. Clients are at different points, so a number is very hard to sort of even arrange, presents some challenges. But we do think in the current environmental conditions that seem to have persistence, having exposure to hedging strategies that can add value through each of those key ingredients of increasing wealth, protecting capital, and being able to navigate through more tumultuous times if volatilities were to stay at least episodically higher, which seems like a pretty reasonable baseline expectation given the world around us macroeconomically, geopolitically, and otherwise. We think that the allocation of hedge funds is certainly sort of trending up, as we've seen in the data you pointed out at the start of the call. And we think that maybe this part of start of a bit of an intermediate to longer term cycle for hedging strategies.
This is a very great conversation because I'm seeing a lot of questions coming through. And Joe, I'll start with you on this one. You and your team evaluate managers, hundreds of managers on an annual basis. Do you see new managers joining this asset class, or will the established large managers really dominate the market and collect most of the money?
Well, it's certainly been the latter. And I grew up in hedge funds in the mid to late 90s, working at a large hedge fund, but seeing how in some ways size could be the enemy of efficacy, right? You get a little too large, maybe you get complacent, maybe your opportunity set shrinks just from having to put capital to work effectively. I do think it's a bit strategy dependent. And what I mean by that is certain strategies, size is a real competitive advantage. And I mentioned like multi-asset class investing before, to be able to attract teams, which Gil hit on a few moments ago, utilizing data, having the right infrastructure, the right risk management processes. There's a reason certain large multi-strategy hedge funds that have 2-3+ decades of success are amongst the largest hedge funds in the world. So I do think certainly in multi-asset class investing, it's almost like infrastructure or platform alpha that they were able to sort of have at least a quasi moat around the success and durability of their businesses. One manager that we work with, it's who probably we've talked about, it's we won't name names on this call, but it's one of the largest hedge funds in the world, one of the longest track records that we've seen going back over 35 years. They just last month, they had their second best month of performance in a quarter of a century. And it happened in a month where equities were down in the US and globally in different sectors. So again, it's just an example of a very large firm in a non-risk on directional market environment can generate an outlier of positive performance because of the diversification of their business, the infrastructure. So I do think size matters for certain strategies where it can be highly advantageous in certain strategies. And then you juxtapose that with some niche strategies, which can be, again, complementary, where smaller assets are probably net beneficial to the execution of that strategy. But most of the firms that we work with are on the larger scale, more established, very, very sort of tier one infrastructure, business operational processes. Again, that's where we think client capital is generally speaking, best allocated towards those types of managers.
We're just about time, so I'll reserve 2 more questions. What's the biggest misconception investors still have about hedge funds today? And Gil, let's start with you, and then Joe. I'd love to hear from your perspective what you most often find yourself clarifying when speaking with advisors and clients.
I think without question, we have to demystify the idea that there's somehow more risk inherent with I think these are just all professional firms that are trying to do the best they can to basically cultivate both a repeatable excellence in terms of what they're doing it from a strategy level, the ability to perpetuate the firm so that it's not something that has limited shelf life. It's very much, these are big organizations now which are spending literally billions of dollars to make things work over the long perspective, and people should feel very comfortable. I'm just looking at the Gulf with what's happening in the last 2 decades. I've been working with investors there. These are some of the best investors in the world, and they have a huge appreciation for what's complementary to their overall portfolio. And it's not surprising to see them putting more effort in looking at either backing or having people work within the environment with hedge funds. So it's very important for people to recognize that this really is a tremendous graduation of gone from something of, 2 people in front of a Bloomberg into a sustainable part of the overall industry, making it a very important part of the complexion of what should be in your portfolio.
Maybe I'd add one, and it's on the complete opposite end of the spectrum. And it's interesting. I do think we are globally demystifying some of these risks. You could just look at fund flows that were at a 20-year high coming into hedge funds. So people are sort of voting with their feet in terms of allocating dollars to certain hedge fund managers and strategies. But Gil hit on, I think the number one misconception is that, gunslingers, wild, wild west, maybe your capital is not entrusted. I would think the opposite is far more, accurate in terms of how the risk management processes have been built out. But the other misconception, again, way on the other end of the spectrum, is that maybe hedge funds underperform, which seems like a bit of a tired narrative. It was, I would say, generically true for, let's say, 10 years coming out of the GFC, when rates are anchored at zero. Again, it's a great environment to just own long and strong risk assets, public and private. Look at the last few years. You can see how certain managers really across the strategy spectrum have been able to provide for clients net of all fees and expenses, low to mid double-digit net returns, low to mid, maybe high single-digit levels of volatility. So you're getting equity-like returns, but you're able to do that with far less dependency on risk assets. So the last several years for us, it kind of coincided with, a different sort of paradigm with respect to global rates and a little more volatility, really hearkening back to the 2022 timeframe, and it has continued. So Gil hit on the perception that maybe risk management isn't as robust in hedge funds. Again, I would strongly and vehemently take the other side of that argument. But similarly, if there's a belief that hedge funds underperform, I think we could look at recent data, we could look at long-term trends, and we look at market outlook. There's a really strong case to be made that actually outperformance could come from hedging strategies across the different investment approaches.
We're just at time, but there's one last question for you, Joe. We've talked about why hedge funds matter, portfolio construction, manager selection. How do we actually implement that? In other words, could you explain how the iCapital platform helps advisors access institutional quality hedge fund opportunities, including the role of your research team and the different implementation options that are available on our platform?
Great question. Try not to turn this into an iCapital commercial. But our business started 13 or 14 years ago, and access was absolutely name of the game. Working with great GPs, not only in hedge funds and in private markets, creating conduit vehicles, feeder funds to gain that, broaden that access to advised clients on a global scale. That remains and will forever be an incredibly vital part of our business. I would say over the decade plus, we've augmented that with education, with training classes, with analytics, just to help advisors feel comfortable with access to diligence and research reports. So it's not just accessing great manager A and then maybe great manager B, thinking a little more broadly about a client's overall portfolio, understanding from an educational standpoint, from a strategy standpoint, from an implementation and analytics standpoint. We've really tried to work all around how advisors can feel comfortable investing on behalf of his or her clients into some of these great managers and how that can benefit the overall portfolio on a long-term basis.
Well, thank you, Gil and Joe, for sharing your insights today. And thank you to all of those that joined. We hope today's conversation has provided a practical framework for thinking about how the role of hedge funds can play within a diversified portfolio. If you have any follow-up questions or would like to discuss portfolio construction, particular hedge fund strategies, or managers in more detail, can you tell them from New York I'm speaking very fast? Please reach out to your iCapital Client Solutions Relationship Manager. We'd be happy to arrange a follow-up discussion with members of our hedge fund research team. Thank you all and have a great day.
Thanks, Priya.
Thank you.
Thanks, Joe.
Yes.